The Hidden AG here. Today is Monday, April 6th, 2026. Silver is sitting at approximately $72.90 per ounce as this new trading week begins. And right now, at this exact moment, three of the most powerful forces in global financial markets are colliding directly inside the silver price simultaneously, not sequentially, not one after another at the exact same time. The Federal Reserve, the oil market, and an active war with a live Tuesday night deadline. Each one of these forces, operating in isolation, would be enough to move silver 5% or more in a matter of hours. Together, hitting simultaneously from different directions, they create something that professional traders call a collision, a moment where the market's pricing mechanism breaks down because it cannot cleanly process contradictory macro inputs at the same time. And here is the brutal reality. A collision does not stay unresolved forever. Eventually, one force wins, one narrative dominates. And when the market snaps into a single direction after a period of collision, the move is fast, violent, and completely unexpected by anyone who was watching the wrong signal. So today, I'm going to give you the complete breakdown of all three forces. What they are doing to silver right now, how they are contradicting each other, where they have historically led, and critically, which one I believe wins this week and what it means for your silver position. Force 1, the Federal Reserve. Let's begin with the Fed, because the Fed controls the dollar and the dollar controls silver in the short term more than any other single variable. At its last meeting, the Federal Reserve held interest rates unchanged at 3.50% to 3.75%. That sounds like a neutral decision. But the reasoning behind the hold was anything but neutral. The Fed explicitly cited inflation driven by the Iran war and the Strait of Hormuz oil disruption as the primary reason they could not cut. They are trapped. The war created an oil shock. The oil shock is feeding inflation. And the Fed's mandate forces them to fight inflation even when the cause of that inflation is completely outside their control. Their updated dot plot, the internal projection system for future rate paths, was revised downward to just one rate cut expected for all of 2026. Earlier in the year, markets were pricing in 2 to 3 cuts. That expectation collapse has been brutal for silver. Why? Because silver pays zero yield. It generates no interest, no dividends, no cash flow. When you hold silver, your entire return comes from price appreciation. When Treasury bonds are offering 4.2% to 4.5% annualized yield with government backing, the opportunity cost of holding silver becomes enormous. JP Morgan's own analysts stated that near-term silver price moves are totally dependent on what the Fed signals about interest rates. That is not a fringe view. That is the institutional consensus. Here is the technical math that makes this even more precise. Market analysts have estimated that every 1 point increase in the US dollar index translates to approximately negative 50 cents in the silver spot price. The dollar index is currently sitting near 100, a 10-month high. Every Fed signal that delays rate cuts strengthens the dollar. Every dollar strength move puts pressure on silver, so why hasn't silver already crashed to $60? That is where forces 2 and 3 come in. Force 2, oil and the Hormuz paradox. The second force is oil. And oil is doing something genuinely paradoxical to silver right now. Brent crude is currently around $110 per barrel. WTI is near $112. Before Operation Epic Fury began and the Strait of Hormuz was effectively blockaded, oil was trading in the $70 to $80 range. The war premium has added $30 to $40 per barrel to the price of oil. Now, normally, oil at $110 should be strongly bullish for silver. Here is why. High oil prices feed directly into inflation. Everything becomes more expensive when energy costs rise. Shipping, manufacturing, agriculture, utilities. Sustained high oil prices erode the purchasing power of paper currencies. And when paper currencies lose purchasing power, hard assets like gold and silver traditionally gain value as inflation hedges. If this were 2010 or 2014, oil at $112 would probably have silver trading at $90 or higher with safe haven demand layered on top. But here is the paradox that is strangling silver in 2026. The same inflation caused by high oil is the exact reason the Fed cannot cut rates. The Fed cannot cut because inflation is elevated. Elevated rates strengthen the dollar. A stronger dollar suppresses silver. So oil at $110 is simultaneously creating the macroeconomic conditions that should push silver higher while also creating the policy response that is pushing silver lower. This is the oil paradox. Silver should benefit from $110 oil in an inflationary sense, but is being penalized for it through the Fed's policy response. We saw this dynamic exposed brutally on April 3rd, when temporary de-escalation signals appeared, suggesting potential ceasefire conversations. Oil prices pulled back, and silver dropped 6.9% in a single session. Think about that. Silver fell nearly 7% on peace signals. That tells you that right now, silver's primary pricing driver is not inflation and not supply fundamentals. It is war premium and geopolitical sentiment. The market has decided, for this specific moment, that silver is a war hedge, and war hedges fall when war threats recede. So now silver is caught in a three-way oil trap. If oil keeps rising because the strait stays closed, Fed stays hawkish, dollar stays strong, and silver stays suppressed. If oil falls because a peace deal emerges, safe haven demand collapses, and silver drops 7% like it did on April 3rd. If oil stays flat and static, the market gets no resolution, and silver grinds sideways in the $70 to $75 compression zone. Every oil outcome is either neutral or bearish for silver in the immediate term. That is why silver has been unable to sustain any rally attempt for the past 2 weeks. Force 3, the war and the Tuesday deadline. The third force is the most time-sensitive and the most binary of all three. Trump's ultimatum to Iran expires Tuesday, April 7th at 8 p.m. Eastern Time. The demand is clear: reopen the Strait of Hormuz. Iran has officially and publicly rejected this ultimatum, calling Trump helpless and threatening to not only keep the strait closed, but to completely seal it while striking energy and desalination infrastructure across neighboring U.S.-aligned states. Meanwhile, Trump has sent additional troops and warships to the Middle East. Force Recon Marines were photographed at Diego Garcia conducting amphibious assault training. Additional carrier strike groups are in position. Eurasia Group's managing director estimated that all additional combat power will be in place by mid-April, and 2 U.S. military aircraft have been shot down, including the F-15E, confirming that this conflict is not a bluff. This is the first time the silver market has opened since Iran officially rejected the ultimatum. Right now, today, this Monday session represents the first real price discovery since that rejection. And the Tuesday deadline creates maximum binary risk inside the CME system, which runs continuously from Sunday through Friday. At exactly 8:01 p.m. Tuesday, the market will react to whatever happens. And both outcomes are bad for silver in the first wave. If strikes begin, the dollar surges as a flight to safety vehicle. Oil spikes. And silver actually tends to drop first in risk-off shocks because of its industrial classification and algorithmic systems, before recovering later on inflation fear. If a deal or extension is announced, the safe haven bid disappears instantly. Oil crashes. And silver sells off hard the same way it did on April 3rd. The Tuesday war force is not simply a bullish catalyst for silver. It is a volatility accelerant that can move silver violently in either direction within minutes. How the three forces interact and contradict. Now let's put all three forces together and see exactly why the market is paralyzed. Scenario 1. A deal is reached Monday or before Tuesday's deadline. The Fed signal becomes more relevant because war fears fade. Oil drops $15 to $20 per barrel. Without the war premium, the market reprices oil-driven inflation lower. Rate cut expectations could return. In the short term, silver initially crashes 5% to 8% on de-escalation, then potentially recovers over weeks as the Fed can consider cuts again. Net Monday reaction, strongly negative for silver. Scenario 2. Trump launches strikes Tuesday night. Oil spikes to $130 or higher. Fed becomes completely trapped because it cannot cut into a real energy inflation crisis, but also cannot hike into war. Dollar has a conflicted reaction. It may initially surge, then weaken as the U.S. fiscal picture deteriorates. Silver initially drops on risk-off algorithms, then potentially surges 10% to 15% over the following weeks as the inflation trade takes over. Net Monday reaction, temporarily confused, then directional. Scenario 3. Status quo continues. Deadline extended. No deal. No strikes. Oil stays near $110. Fed stays hawkish. Dollar near 100. Silver stays in the $70 to $75 compression zone. No resolution. Maximum frustration. Net Monday reaction, sideways, slightly lower bias. Scenario 4. A genuine ceasefire framework emerges with verifiable steps. Oil drops sharply. Rate cut probability rises. Dollar weakens meaningfully. Silver potentially rallies 8% to 12% over several days as the combined macro environment shifts from hawkish to supportive, but the initial Monday reaction may still be lower before the rate cut repricing builds momentum. The problem is this. None of the four scenarios is clearly and immediately bullish for silver on Monday in a sustained way. Every outcome requires time to develop the bullish second-order effects. And in the first minutes of each reaction, silver faces downside risk before the recovery narrative builds. The historical precedents. This kind of three-way collision has happened before, and the historical patterns are instructive. Gulf War, 1990. Oil spiked significantly. U.S. military engaged heavily. Fed eventually cut into the economic slowdown that followed. In the first phase, silver fell along with broader markets. Then, over the following 12 months, silver rallied 30% to 40% as inflation expectations shifted and the dollar weakened on rate cuts. 2008 financial crisis. The Fed cut emergency rates to near zero. Oil crashed from $140 to $35. Markets globally collapsed. Silver fell 50% in the initial panic, then rallied over 400% over the next 3 years as money printing drove a massive wave of real asset demand. 2022 Ukraine invasion. Oil spiked. Fed was hiking. War began suddenly. Silver experienced volatile swings of plus or minus 10% daily for approximately 2 full weeks before it found direction. Ultimately, the hawkish Fed dominated and silver drifted lower. The pattern is consistent. When all three forces collide, the initial market reaction is almost never the final direction. The first weeks are about confusion and violent swings. The resolution comes 4 to 8 weeks after the collision, when one force achieves dominance. Which force wins? This is the question every silver trader is trying to answer right now, so let me give you my analysis. In the very short term, the next 72 hours, the war force dominates. Tuesday's deadline is the most time-sensitive catalyst. Whatever happens at 8 p.m. Tuesday will temporarily overwhelm both the oil paradox and the Fed calculation as the immediate market driver. In the medium term, weeks 2 to 6, the oil force takes over. If the Strait of Hormuz stays partially or fully closed, sustained oil above $100 will eventually feed through into the broader inflation data. At some point, the inflation argument for holding silver becomes impossible to ignore, even with a hawkish Fed. In the longer term, months 3 to 6, the Fed force wins. If inflation stays elevated and the Fed cannot cut, dollar strength will remain the dominant macro headwind for silver. But if the war resolves and oil normalizes, the Fed gains room to cut, the dollar weakens, and silver's full medium-term rally can develop. The collision this week is acute and dangerous, but the resolution almost always favors silver 6 to 12 months after a three-force collision event. Every historical precedent shows that silver was higher 12 months after the collision than at the moment of maximum confusion. The indicators to watch today and tomorrow here is your specific Monday monitoring list. Watch the DXY dollar index. If it breaks decisively above 100.5 during Monday trading, dollar strength is intensifying and silver faces immediate headwinds. Watch Brent crude. If it pushes above $115 during Monday, the oil paradox tightens. If it drops below $105, watch for a potential replay of the April 3rd de-escalation sell-off. Watch the 10-year Treasury yield. If it moves above 4.5% during Monday, institutional money is pricing in more Fed hawkishness. Silver will struggle. Watch for any Fed speakers. Multiple members of the Federal Open Market Committee may resume public commentary this week after the holiday closure. Any new forward guidance will immediately move the dollar and silver. Watch the Iran response. Any communication from Tehran or Washington about ceasefire negotiations will move silver before Tuesday's deadline. A soft signal of talks resuming could push silver towards $70. A harder rejection or military incident could briefly push it toward $75 before reversing. The bottom line? Collision is now. The Fed wants to hold rates high because of oil-driven inflation. Oil is high because of the Iran war. The Iran war has a binary deadline in 36 hours. And all three forces are hitting the silver market simultaneously at $72.90. This is the collision. You are inside it right now. The worst thing you can do is make a leveraged directional bet in the middle of a collision without understanding which force is about to win. The best thing you can do is understand the mechanism, know the scenarios, and position accordingly for the resolution that comes after this week's chaos clears. This is the hidden AG. The collision is live. The resolution determines the rest of April.